And that's the deal. With retained earnings, the way you break it is you change the past. Stuff sent off to the bookkeeper and you're like, oh, that invoice dated December we sent to the client isn't quite right. I'll just fix it. No, you can't touch it. I did a training recently that Jackie Rockwell put together for me, lucky me, but we had hundreds of people attend the event and there were so many questions we couldn't answer them all, and so Jackie grabbed a few, and my homework assignment is to do these videos to answer the questions. Our next question is, what do you mean by not changing retained earnings? So in the presentation, I explained how to be the CPA's favorite bookkeeper. And on the flip side, what causes the accounting staff a lot of extra work and how can we mitigate that? And one of the things that I mentioned was you should not change retained earnings. And the person's like, well, what do you mean by that? Great question. If you're a bookkeeper that has not spent very much time looking at the financials and understanding the financials, you might not even know what retained earnings is. From a theory perspective, what you would get if you went to got an associate's degree or got a bachelor's degree, what they would explain is retained earnings is exactly what it sounds like. It's all of the funds that were retained in the company. So at the end of every year, the software, whatever software platform you're using, the software takes the total profit of the year and they move it into retained earnings. So you start out every year, every fiscal year, you start out with zero on your profit and loss, right? It's completely blank. And what happened was the prior year's profit was moved into retained earnings. So in the purest sense, if you look at retained earnings total, it's all the profit or losses you've had in all the years you've been in business. But sometimes the CPAs, not all of them and not all the time, but sometimes the CPAs also journal other things into retained earnings, which is totally legit, but they just don't all do it, and that's fine. They'll move owner's distribution and owner investment also into retained earnings, and it all gets smushed together, and then that's the remaining money in the business. The idea being company made $100,000 in profit, but the owner took $80,000 as distribution, so all that's really retained in the company is $20,000. Now, how do you totally jack up this account? Let's talk about that. So the way it would work is hopefully you're not ever putting any journal entries or any transactions to retained earnings. That's not our playground. That's the CPA playground. We don't touch it, okay? But the ways you can break your retained earnings is if, let's say it's 2039, the year 2039, and you discover with your new job or your new client that there's all this old stuff in the checking account. Goes back to 2020, right? Got 19 years of garbage. What I called in the training, these zombies, whoa, all these undead, living forever transactions that are stuck on your balance sheet. If you go in and delete all of them, you're destroying the retained earnings numbers. Once we close the books and it goes to the CPA for tax prep, we may touch nothing in the prior years. So if you find an old weird transaction somewhere, you cannot just void it or delete it. You have got to do a reversing entry in the current year. And that's the deal. With retained earnings, the way you break it is you change the past. Stuff sent off to the bookkeeper and you're like, oh, that invoice dated December we sent to the client isn't quite right. I'll just fix it. No, you can't touch it. The books are closed. It's all over. And that's why it's so good to do a full year-end close and make sure you very thoroughly scrubbed the books and everything is perfect. Because once it goes off to the CPA, that's it, locked down. You shouldn't touch anything. You should lock the books with a closing date, and you should not use the password to change things. In summary, to answer the question, what do you mean about not changing retained earnings? You must never touch the past. You must never change the past. We do not have time machines. You cannot go back and change an entry from 2020 when it's 2025 because all of that's already been on a tax return. All of those expenses that are erroneously in that checking account, my pretend checking account where we've got 19 years of garbage stuck in there, all of those expenses were written off on tax returns. You can't just go in and delete them now. You have to reverse them, and the reversal is actually showing other miscellaneous income for the amount of all of those uncleared things. So businesses can take a really big hit when they are not cleaning the books every year, and then maybe 5 years down the road or 19 years down the road, they decide to clean the books. And then they end up with, maybe tens of thousands of dollars of other income for expenses that were written off on tax returns but were never really real. That is the deal. If you don't want to hurt retained earnings, you have to make sure you lock the books and you don't touch anything with a prior period date. Once that stuff's sent off to the CPA, that way everybody will be happier during tax season.